Hi there. In 2026, HMRC is cracking down on crypto and NFTs. Are you compliant? Let us help you.
All right, let's talk about something that's on a lot of people's minds, crypto tax in the UK. Specifically, we're looking at NFTs and digital assets as we head towards 2026. Now, all the insights we're about to share come straight from the expert tax advisors over at My Tax Accountant. And trust me, you're going to want to pay attention because the rules are changing in a massive way, and what you don't know could really, really cost you. So let's get right to it.
Okay, let's kick things off with a number, £300. Now, I know what you're thinking. That doesn't sound like a life-changing amount, right? But what this number represents, well, it signals a huge shift in how the tax man is looking at your crypto.
Because that's, my friends, is the potential fine per user that could hit crypto platforms if they fail to report your data to HMRC from 2026. Yeah, you heard that right. It's not just some little slap on the wrist for the big exchanges. No, this is HMRC sending a crystal clear message. The days of crypto tax being a kind of confusing gray area, they are officially over. Total transparency is the new name of the game.
So, what's behind this massive change? Well, there's a huge global shakeup on the horizon, and it's called the Crypto Asset Reporting Framework, or CARF for short. You can think of it as a new international agreement where countries share data on crypto assets, and you can bet the UK is fully on board. Let's break down what this actually means for you and your wallet.
You can see right here just how quickly things are changing. I mean, before 2025, HMRC's view of your crypto activity was, well, let's just say it was limited. Then, boom, they added a new crypto section to self-assessment forms. And now, the big one. From January 1st, 2026, CARF goes live. This means a direct data feed from exchanges all over the world is going to land right on HMRC's desk. That little window of privacy, it's closing. And it's closing fast.
And we're not talking about some vague, high-level data here. Oh no, this is incredibly specific. Your exchange will have to report your full name, your address, your national insurance number, everything. The type of crypto you traded, the total value of your trades, even your wallet addresses. You know, a lot of people assume their activity is pretty private, or at least pseudonymous. This catches a lot of them out. Under these new rules, every transaction is directly linked to you. There's really nowhere left to hide.
And don't for a second think HMRC is just sitting around waiting for 2026 to roll in. Nope, they're already using the data they have right now. You'll want to hear this part. They've sent out over 65,000 of what they call nudge letters. And these letters are basically HMRC saying, hey, we think you have some crypto, but we don't see it on your tax return. Maybe you should take a look at that. It's a very clear warning shot.
Okay, before we even get into tax rates and allowances, there's one question you absolutely have to answer. It's probably the most important question HMRC will ask. Are you an investor or are you a trader? And this is absolutely crucial because the answer determines which set of tax rules you need to follow. If you get this wrong, everything that follows is wrong too. So let's make this simple. On one hand, you've got the investor. This is someone who generally buys and holds, hoping for that long-term appreciation. It's not their main source of income. On the other hand, you have the trader. We're talking frequent, organized, short-term activity. It looks and feels like a business. Now, the good news for most of us is that HMRC considers the vast majority of people to be investors. They've said that only in exceptional circumstances would they class you as a trader. So, how do they decide what counts as exceptional circumstances? Well, they don't just pluck it out of thin air. HMRC uses a tried and tested framework called the Badges of Trade. Think of it as their official checklist to figure out if what you're doing looks more like a proper business than just a personal investment. Now, there are 9 of these badges in total, but for crypto, these are the ones that really matter. So ask yourself, are your transactions frequent and systematic? Are you buying and selling really quickly, like within days or hours? And are you using complex tools like trading bots or working to a formal business plan? If the answer to these is a resounding no, then you're almost certainly going to be treated as an investor. Which brings us to the next big question. What tax will you actually have to pay? Right, so once we've established you're probably an investor, we can focus on the tax you'll be dealing with, which is capital gains tax. And that's good news because the rates are generally a lot lower than for income tax. So let's make this really simple and just look at the key numbers you need to have in your head for 2026. First up, the big one, your tax-free allowance. It's officially called the annual exempt amount. For the 2025/26 tax year and beyond, that's set at £3,000. And this is so important. You only pay tax on gains that are above that £3,000 threshold. It's a use it or lose it deal each tax year, so you can't carry it forward. Okay, so what's the rate?
If you're a basic rate taxpayer, any taxable gains you make will be taxed at 18%. It all depends on your total income for the year. If your income plus your gains keeps you in that basic rate band, this is the number for you. And then we have the higher rate. If your income for the year plus your crypto gains pushes you into the higher or additional rate tax brackets, then you'll pay 24% on that portion of the gain. It's all about where your total income for the year lands you. Okay, here's where it can get a bit tricky. When you're calculating your gain, it's not as simple as just picking which coins you sold to get the best tax outcome. You can't just say, oh, I'm selling that expensive Bitcoin I bought last year, not the cheap one from ages ago. HMRC has a very strict, mandatory set of rules you have to follow in a very specific order. You have to work through these steps in this exact order. Rule 1 is the same day rule. Any coins you sell are first matched against any you bought on the very same day. Simple enough? If there aren't any, you move to Rule 2, the 30-day rule. You look to see if you bought the same crypto back within the next 30 days. And if you still have coins left over after that, they're matched against what's called the Section 104 pool, which is basically just the average cost of all the remaining crypto of that type that you own. Okay, stay with me, because this next bit catches out nearly every active crypto user. It's called the bed and breakfasting rule, and it's designed specifically to stop people from creating fake tax losses. You know, like selling your Bitcoin at a loss just to lower your tax bill and then buying it straight back the next day. HMRC is wise to this. They say that sale has to be matched against the new purchase price, which pretty much cancels out the loss you were trying to create. Right, so everything we've just talked about, the pooling, the 30-day rule, that all applies to what we call fungible crypto. Think Bitcoin, Ethereum, where one coin is exactly the same as any other. But what about NFTs, non-fungible tokens? By their very nature, they are unique. And guess what? That changes the rules completely. Yeah, because every single NFT is a one-off, HMRC treats them completely differently. You can't pool them, there are no same-day or 30-day rules to worry about. It's actually beautifully simple. The calculation is just the selling price of that one NFT, minus what you paid for that exact same NFT. That's it. Nice and straightforward. Phew, okay, we have covered a lot of ground there, haven't we? From global reporting frameworks to those tricky calculation rules. So, what does this all mean for you? Let's boil it all down into a clear action plan to help you get this right and, most importantly, stay on the right side of HMRC. Okay, these are the absolute must-dos. First, figure out if you're an investor or a trader. Next, get your records together for every single transaction, and you have to keep track of the value in pound sterling on the day of each transaction. Don't forget to include costs like gas fees, and remember, and this is a big one that catches so many people out, swapping one crypto for another still counts as a disposal for tax purposes. Finally, if your gains are over that £3,000 limit, you've got to report it. So I'll leave you with this one final thought. For a long, long time, crypto tax was all about voluntary disclosure. But from 2026, with this automated global reporting becoming a reality, keeping good records isn't just good practice. It's your best defense. It's your only defense. So the real question is, are your records ready? Now, of course, we have to say that all of this is for general guidance only. Tax law is incredibly complex, it can change, and everybody's personal situation is different. So please always seek professional advice that's tailored to you before making any decisions. And if you want to navigate this new landscape with real confidence, we highly recommend you talk to the experts. You can get in touch with my tax accountant for personalized advice. Their phone number is 020-8570-8531, and the email is info@ytaxaccountant.co.uk. And hey, while you're at it, why not subscribe to the My Tax Accountant channel for more clear and practical updates just like this? Thanks so much for watching.